All right, we're live. It's the Mitch and Bobby show. I'm going to call it the Bobby and Mitch show. So stocks plummet today. People are have concerns from the yield curve, which we're going to talk about extensively. Interest rates are down a little bit. People go from thinking, the Fed's going to pause from raising rates, the economy's going to rebound, soft landing. Now we're going into recession. The Fed's not going to pause, hard landing all the way. Earnings estimates coming down and more. Just a lot of things to worry about today. As a result, stocks went in the tank today. It's turning out to be a really crappy end of year before the holidays. And we need to talk about this. We need to see if we need to take the really hard hit to the economy more seriously, because that typically would have a pretty big impact in the stock market. Or I don't know who first said it, but there's an old expression, you ain't seen nothing yet. And that could go for how bad the stock market's been this year. So Bobby is joining me, and he's going to help us talk about, there he is. We're going to talk about the yield curve. But first, I just want to put something up while I have you. All right, pop us up over here. All right, just to show you, the Dow down over 2%. NASDAQ down over 3%. That is a lot. S&P down 2.5%. Oil is down. VIX is up a little bit. Yields are down a little bit. This is all indicative of what you would expect to see heading into a recession. But one of the biggest signals of heading into a recession are yields. And if you see this, I'm going to highlight this over here. The 10-year yield is 3.45. But the 3-month is 4.32%, and the 2-year is 4.2%. Bottom line is, when you invest longer term, you should get a higher return because you're taking more risk in terms of time. The longer you invest for, the more things that could possibly go wrong, and the more inflation is expected to rise over time. Okay, inflation eats away at your returns. So therefore, you should be getting more return above and beyond short-term yields, but it's inverted. And that's what we're going to talk about. So let's get back to camera one. And we went over this paper here from Zero Hedge. I don't know if you could see it from Zero Hedge. Just so we all know that Tyler Durden is usually an apocalyptic forecaster and writer. He doesn't put anything out that I've seen that's positive. And overall, the market has tended to rise over time. So all the negativity in the world still has been defeated by all the positivity in the world. But we should definitely talk about this because we want to know what's going to happen with our money, right? And we want to see if we should be taking steps to prepare for a down market. And if you're closer to retirement or in retirement or closer to needing your money for another financial obligation like college, these are things you might want to take into consideration. So let's throw it over to Bobby. We are going to get another mic. So we didn't expect to be sitting right next to each other for the live stream. So we're sharing the mic now, but I will have another mic very soon, and we won't have to do this all the time. But let me move it over to Bobby. Here you go.
I feel like I'm on like the train again, like the subway, when you're standing, right next to each other.
And every time the train rocks, you go this is what happens. You're in the subway and the train rocks. You go like this.
Right, exactly. It's like you bounce into each other. Well, there's no one else I'd want to. Well, there is one other person I'd want to sit this close to. So, but the other one is you, Mitch. So okay. I'm honored.
I'm number two.
But we are waiting for the Santa Claus rally, which every day that goes by seems like it's less and less of a likely scenario to play itself out. So it looks like everyone's getting coal for the end of the year this year. But
it's getting late in the game for the Santa rally.
It is. Amazon better quickly deliver. Mitch is right. We take a look at a number of economic indicators when we, assess risk to the market. And a classic case is the shape of the yield curve. So as Mitch said, a normally shaped yield curve goes in upward trajectory, right? So it's lower on the short end, higher on the longer end.
Lower left and it gradually moves higher
right.
as you go to the right.
Right. So, but since 1986, every inversion of the yield curve has been indicative and a forecaster of a recession.
I
Right?
actually think it goes back a lot longer than that for a perfect track record, but this is what they state in the paper, so we'll
Right.
go with that for now.
So it's a matter of, assessing where we are, um, you know, how far does the yield curve invert, right? So it's 81, 83 basis points now. It's the most it's been inverted in a very long time. So, we are cognizant of that and have been taking appropriate actions with client portfolios over the last several weeks and months. It's kind of interesting. This will probably be the third time that we've had a bear market rally that has turned around to go back down this year. So it's
Yeah.
been a volatile year.
And I just want to say that one of the things I'd spoken about recently was I call this the Charlie Brown market, because how Charlie Brown runs to kick the ball, Lucy holds the football, and Charlie Brown runs to kick it. And every time he falls for it, she pulls the football away. He flies up in the air and lands on his back. This keeps happening to investors. So that's why we call it the Charlie Brown market. We get excited. We say, oh, the Fed's going to stop raising rates. This is it. Everything's going to go back to what it was a year or two ago. And every time investors' hopes are dashed. And this is why we build portfolios that are made to withstand this. Not to say that portfolios can't go down. It's just we have portfolios designed based on people's needs and the timing until they need their money out of the market for financial obligations. So we don't spend a lot of time getting computer face, just being stuck looking at the computer and doing nothing else. We're just here servicing our clients, guiding them through different life cycle events. And there's really that's what we do. In this whole market, this doesn't ever throw us off of doing that. That's the important work that we do.
No, you're exactly right. So, I think what's on a lot of investors' minds, right, is where we go from here, right? We've had a year where the indices are down, somewhere 15, 20%, on the year. It looks like going lower. Where do you think, Mitch, earnings are going to play out? Because there are certain sectors that are still pretty rich, and there are some sectors that are still pretty affordable. And I think that trying to find those pockets of the market, to get growth from is going to be key to, preserving and growing, right? So there are certain times in the market where the return of your money is more important than the return on your money, right? And this is one of them.
Right, so I actually was thinking about this, and I just jotted down a couple of notes. I can't even read my own handwriting. Okay. It's basically two schools of thought. The stock market has bottomed already this year, and we're not going into a recession. Or if we do, it'll be very mild, statistically mild. Not to say that certain parts of the economy won't feel more pain than others. Or we're having a really bad recession, and the stock market is going to retest its lows, and then a whole hell of a lot more. They're both pretty compelling, but I think the going into a recession is more compelling. I weigh the evidence, I weigh the stats, and it looks more like recession. And the Fed met on Tuesday, and people getting all, up into a tizzy to say, oh, the Fed's going to announce that they're going to raise half a point Tuesday, a quarter point in their next meeting, February 1st, and maybe a quarter point after that. And they're just going to pause. And then, 6 months later, by the end of 2023, 9-10 months later, they start to reduce rates. What Jerome Powell said yesterday in his commentary is that no, we're not really pausing. In fact, we've raised the terminal rate of how high we're going to go with rates, and that's now 5.1%. But some of the Fed governors are thinking, even higher than that,
No.
right?
Yeah. Yeah. No, and I think what set the market off today, to your point, is expectations, right? So a lot of participants in the market had very high expectations that the Fed was going to announce that they were going to either pause or reduce the rate of increase of interest rates. Um, and those that expected that were gravely disappointed, obviously, as today
Yes.
today
100%. And
indicated.
yesterday too.
And yesterday too, right?
This is a tough week we're having.
Yeah. So I think there, it's bringing us back to a situation where I think you're right. I think we have to prepare for the reality and likelihood of a recession. It's been the recession in 2020 was so short-lived, and I think it's kind of like when you get like those hurricanes that are forecast and they really don't come to fruition, people tend to not take the next one all that serious.
Yeah.
I think this is something similar, where
Okay.
I think we have to take it serious and not just say, well, the last one was pretty shallow, so this one's going to be as well.
Yeah, we we tend to have a it's called recency bias. It's actually a term, recency bias, where investors keep going back to the same stocks that were the winners of the last bull market. We tend to think that the next bull market or bear market will be identical to the last one because that's our clearest and latest frame of reference. But so a couple of things that add weight to the recession side. Again, but I just want to make this clear, okay? When we say the odds of a recession are higher than not, and you hear this all over the financial news media, this does not mean you get scared, okay? Nothing changed from yesterday to today. If we're thinking this, well, it was probably on the way already. It doesn't mean that you need to run out and sell off your entire portfolio. It doesn't mean you need to make sudden, rapid, crazy changes to your portfolio, all out of the stock market, all into the stock market. That's not at all what we mean. Our belief is that time in the market ultimately is more important than timing the market, and investing regularly, holding on for the long term, dividends, that sort of thing, rebalancing will get you much further ahead in the next 10, 20 years or more. Even if you're in retirement, it doesn't mean you turn your whole portfolio into cash and just live off that, because you want to try to keep ahead of inflation. So I just want to make that point. Okay. So liquidity, money supply is starting to whittle down a little bit over the next, going out 6 months. This is according to Jeff Gunlack from Double Line. He's considered the bond king and manages the biggest bond fund. But if you expect to be in a recession and earnings would go down because the economy is weaker, it means investors don't want to pay as high a multiple for companies based on 2023 earnings, 2024 earnings, and even 2025 earnings. So that makes it much harder for the stock market to actually recover, but it makes it easier for the stock market to go lower because investors lose interest in that. Okay. Estimates for the last quarter, companies beat estimates by a ton last quarter and almost across the board, but those were greatly reduced earnings expectations on the estimates. And generally speaking, the feeling is that earnings estimates have to be cut even further, which means stocks have to be repriced to reflect that. And then there's quantitative tightening. The Fed has a massive balance sheet, and they've said, they're reducing their balance sheet by $95 billion a month. So that's withdrawing a lot of liquidity out of the banking and sector, the financial sector. So those are some things I want to point out.
Yeah.
Your turn.
Yeah, no, you're right there. As rates go up, right, it becomes more and more costly to borrow, right? So that's kind of the whole point is reducing the supply of money, or the velocity of money, if you will. And the other issue here is the S&P's forward earnings multiple. I think it's trading at 17 times. Right. So you've got some sectors that are still, I was looking at Costco. Do you know what Costco's PE is? 35.
35.
Twice as much as the S&P, right? Whereas a company like Exxon, and by no means are we trying to, promote certain names, but we're just, trying to put everything's in perspective. Exxon is 8 times, right? So it's still very reasonably priced. So, there are going to be some names and some sectors that, even though they've come down in value, still have a ways to go if those earnings don't continue to keep pace and grow. Whereas there are other parts of the market that still could see, some growth in earnings, and therefore at least not go down or maintain their value. But I think you're right. This is a time where you need to know what you own, right? If you don't have a professional money manager who's assessing all of these companies and sectors, is knowing what you own and the risks for continuing to own stocks that don't have earnings growth or don't have earnings at all. This is a very tough environment to make money in.
So there could be sectors that are cheap. And listen, just I personally, I don't know how I don't speak for you with what I'm about to say. I just want to speak for myself. I don't pray at the altar of P ratios, because P ratios are often a factor of accounting. I don't want to say gimmickry, but they're not really like measuring something like cash flow. However, just because a stock has a low PE ratio doesn't mean it's cheap. Just because a stock is at a year low does not mean it's cheap. And just because a stock went down a lot doesn't mean it's cheap. Just because a stock has a higher than market multiple doesn't mean it's expensive, and doesn't mean it can't go higher. So that's what makes it so tricky, I think. And just so we know, diversification is a strategy we use that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. Obviously, like we see now, that's the toughest thing I think this year, because you have emerging markets, you have small cap, large cap, mid cap, and you have bonds, and they're all down. It's that is what is so hard this year, and that's we find ourselves explaining that a lot, and hopefully the message gets through. So the other thing is, you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. And we think of the S&P 500 as the overall market. It does represent about 80% of the U.S. stock market cap, but it's still very heavily weighted toward technology. And, I remember when Facebook went from like 340, 350 down to 200, there were people on CNBC. I'm not going to name names, but we saw one of them speak at our conference in Florida recently. Okay, Mr. W something, right? Yeah. And I remember him saying on CNBC, I like Facebook at 200, down from where it was, and under 200, I want to buy it. Now it's in the low 100s. Don't ever think that what a bottom could be in a stock, especially if it's tech related. These things could go much lower. I remember when Lucent went from 100 to $1. We have a question/comment out here from our friend Eric. Hey, Eric, how are you? Do you think we'll have a recession with unemployment under 5%? Or do you think the Fed is taking unemployment over 5%? I'll give you that one first. And then whatever you say, I'll just say the opposite. So we know that one of us will be right.
Right.
Okay.
I mean, that's what makes a market, Mitch, right? That's what makes a market. Do I think we'll have a recession with unemployment under 5%? Well, I mean, as we saw with the November jobs report that was released in early December, employment growth is still, it's relatively high still, meaning that we haven't seen kind of, a complete turnover in
jobless claims this morning came out lower.
So there's
still a lot of strength.
Yeah, it's probably not uncommon, or you could have a recession, right, with unemployment still relatively low historically, right? Because you got to think of it. We always have population growth, right? Albeit we do have a lot of people who are retiring. There's a lot of demographic data that goes into the employment
And we
data.
have a shrinking labor pool
Right.
also.
So, if the unemployment affects those that are earning more, you know, take take for instance the tech industry, or investment banking, or financials. If that's where a majority of the job losses are going to come from, albeit not that great, it's probably going to have a greater impact on the economy overall than for retail or something like that to
Right.
see a
So
loss. So
it could be, a recession, not in the way that we think of them as they were in like the 60s through 1990s. It could be not everybody goes through a recession the same. There will still be industries that thrive through a recession, like bankruptcy attorneys, for example, could thrive. Okay, but it doesn't mean every sector falls apart. We could see oil hit the skids if oil goes down to, I'm just making this up right now, but like $50 a barrel and stays there. That's going to change the dynamic for the oil sector. You're going to see a ton of layoffs. And if you want to know, or if you want a real life example of recession after recession after recession with low unemployment, you know, take a look at Japan. Japan has just been in these rolling recessions for almost as long as I could remember, and they have low unemployment, still a decent, one of the best standards of living in the world. And their big problem is demographics. Just their population is aged, they have fewer children, and there are some striking similarities to the US economy. The one thing we have is population growth because of immigration. Japan doesn't have any of that. But yeah, we could definitely have a recession. And then again, the Fed could actually, I mean, from everything I see and Bobby sees, we all see is the Fed wants unemployment to go up. Okay, and if we have that, that'll squash demand and at least give supply chains a chance to catch up to demand, or let demand go down long enough for that to happen. And that is recessionary.
yeah, I think
It's
it's
an
more
adjustment.
productivity, right? Because companies are able to do much more with less people. It's just it's the natural trajectory of technology. Um, so if we can see productivity stay high, I think you could see a recession, perhaps, with unemployment staying relatively low. Now that could all change, right? But yeah, I think that's what's going to happen. I don't think we're going to see a very high unemployment rate, but we could certainly see a recession.
I agree. Well, we do agree. So we're both taking the same side of the trade here. Okay. So I want to talk to you about the foghorn is blowing, but few heed its warning, and it's basically saying, this paper from Zero Hedge. It's a great article, and if you email Bobby or I, rbird at clientfirststrategy.com or mgoldberg at clientfirststrategy.com, we'll email you the article. It's really a good one. But he basically says that we're whistling past the graveyard. That when the foghorn blows, if the water's calm, nobody pays attention to it until the boat scrapes the bottom of the wherever the shallow tide, the low tide is.
Yeah.
And
Yeah.
so the yield curve actually says we're heading into recession. There are plenty of data points that say we could be in a recession. Some say we're heading into one. But the interesting thing is that with the yield curve, we typically don't go in. It seems that when the yield curve finally goes up is when the recession starts. But I feel like we could already be heading into it now. What do you think?
Yeah. So right, the article kind of points to to history saying that, the worst of the drawdowns of a market generally don't start until after the yield curve normalizes after being inverted. Does that make sense?
Yes.
So it's inverted now, right? How does a yield curve invert, or how does a yield curve uninvert?
Well, I have the answer.
So, but
You
it's
want to say it?
it's well, no. It's not until that happens that we start to see the worst of the of the drawdowns of the market. So, go ahead and tell
All right.
our clients and audience
So-
how it uninverts.
Okay, so when you head into a recession or the economy slows down, it makes long-term bonds more attractive to investors. So investors buy the bonds, they go up in price, which means the yield goes down. Short-term bonds, the yield goes up because those short-term yields are more sensitive to increases in the federal funds rate, which is what the Fed's controlling, what the Fed's raising. So therefore, if right now the Fed funds rate it's a range 4.25% to 4.5%. So therefore, short-term bonds, 3 months, 6 months, a year, 2 years, are about 4.5%. So when the Fed gets to the point where it starts to cut rates, let's say we go down from 4.5 to 4 to 3.75 to 3, that means obviously short-term yields are going up. And even if long-term yields stay the same at 3.5, as the short end starts to come down, that'll make the yield curve flat, and eventually it'll revert again. Okay, it'll make it into an incline curve. So that's how it works. Or what the Fed could do is they could just blow out of their massive portfolio of long-term bonds with massive quantitative tightening and just flood the market supply with long-term bonds. There's a couple ways it could happen, but typically speaking, when we go into a recession, the Fed starts to cut rates. That makes short-term bond yields go down, and it does make long-term bond yields start to go up, because if you cut rates, you could start to create more inflationary forces, which is a negative for investors who want to buy long-term bonds, which means they start to sell them and they won't start buying them back until the yields are higher. A lot of circular stuff going on here. I know. All right.
There is. It's look, this is the beauty of it. This is economics, right? This isn't sexy investment banking stuff, but
No,
this
is the boring stuff.
This is the boring stuff, but that's what we get paid to do. We're keeping an eye on the trajectory of this inversion, right? So we're now at 81 basis points, 3-month, 10-year. When we start to see that start to normalize or get closer to zero,
So we want it to shrink. We need it to shrink first before
Right.
we could get to normal.
So anything can happen here, but I think the market's path of least resistance here is down.
All right. Well, that makes a lot of sense. Again, folks, we're not suggesting that you act on this. This is not necessarily investment advice to you. You should consult with your own personal financial advisor and make sure you're acting in what's in your own best interest and for your family. So, but if you want to have a candid conversation about how all of these things could impact your portfolio and what to do about it, definitely give us a call. I guess I'll say our phone number, 631-920-6622. And I see Justin is out there. Thank you very much, buddy. Thanks for joining us. If you like what you see here, please give us a thumbs up or a heart or an applause, depending on which social media platform you're watching from. We really appreciate that. It helps spread the word of the good work we're doing here. Okay, I'm going to end the broadcast, so we're going to say goodbye. All right. And if something crazy in the market happens, I'll be back tomorrow. If not, I'll see you Monday. Thanks for watching, guys. We really appreciate it. Bye. Okay.